So a very good morning to everyone attending, and thanks to Team EduBridge and Girish for having me here. So this session is not going to be just about mutual funds, but also about the concept of investing in general and how we can use it to transform our lives in the future. So, I'm sure most of you will agree with the statement that I don't earn enough. A lot of times at the end of the month, we feel that we don't have enough money left in the bank, or, I couldn't buy something that I wanted to because I don't earn enough. Well, maybe it is true, maybe you don't. And you should aspire for better paying jobs by constantly skilling yourselves and exploring better opportunities. And my best wishes to each one of you for this. But most importantly, think about this. Our needs don't change significantly over time, but what we want, our wants multiply. So we eat the same amount of food, but we want to buy the latest and greatest phone. Here, food is the need and the phone is our want. Similarly, the house we live in remains the same for a couple of years, but we want to buy that latest and big screen television whenever it launches. Here, the need is shelter, and the big screen television is the want. So, what are these wants? These wants are just short term financial goals. Sometimes these are impulsive, like that birthday gift for yourself, or a price drop during a sale when that TV is suddenly available for a very attractive price. But a lot of times these are planned as well. Now, coming back to my previous point, most of us are able to meet our wants or our short-term financial goals in the same salary, in the same income, but realize that we don't have enough when we want to buy a house or buy a car or put aside money for retirement. Maybe this is because we are sacrificing our long-term financial goals for our short-term financial goals. And this is where investing comes in. So, the way to think about investing is it is a means to meet your long-term financial goals by saving so that you are able to beat inflation, but importantly, not end up spending everything on your short-term financial goals or your wants. Right now, uh, let me give you a snapshot of some of the long-term financial goals that a lot of us will have. Maybe you want to buy a house in the next 10 years. If you have kids, maybe you want to put aside money for higher education for your kids, or even for yourself. Uh, Maybe you want to buy a car, or if you already own one, then you want to upgrade your car in the next 5 years, in the next 10 years. And importantly, are you thinking about retirement? Because once you retire, the salary as a source of income will cease, and then you will need an alternate source of income to meet your needs. So these are effectively our long-term wants, our long-term financial goals, and we should think about, saving some money and putting some money aside for these things, for these long-term financial goals. Now, investing is effectively, creating a plan and putting aside money to save for your long-term financial goals. Let me also, spend 2 minutes on why do each of us not invest? And this was true probably for the first 5 to 6 years of my career, where one of the reasons was I don't have any left. I don't have any money left to invest, uh, or we have too little to invest. So here, the thing is that you can start with as little as 500 rupees or 1,000 rupees a month, and as your income grows, as your financial wellness grows, you can increase that amount and save and put aside more money. Fundamentally, what you are looking at is, just as an illustration, if you start saving at when you're 30 years old, let's say you save 5,000 rupees a month, over a period of, by the time you're 60, that 5,000 rupees a month will translate to 3.5 crores, assuming certain rates of interest and certain return that you will be able to generate from your investments. This is at age 30. If you start investing when you're 40 and you invest 3x, 3 times that much, which is 15,000 rupees a month, that will translate to 2.5 crores or 2.3 crores. So effectively, the point here is the more you delay your decision to start investing, the more you delay, saving money aside for your future, the more money you will need to put aside to meet the same long-term financial wants or your long-term financial goals. Uh, the other reason to not invest is we don't understand, uh, where to invest. I don't know how, I don't know where to invest. It is too risky. I don't want to invest in instruments or in things which I don't understand. I just want to invest in, I don't want to take risk, and I just want to, maybe I'll just put aside money in fixed deposits. uh, well, the way to think about this is that if you are investing for the long term, if you are investing for 5 years, 10 years, 15 years, and so on and so forth, like some of the goals that we discussed earlier, those are long term financial goals. And in each of these cases, in each of these scenarios, taking this risk that is that you think that you are taking can be helpful, because over a long term, the returns from these investments, the returns from these instruments, are generally, at least in the past, they have tended to be far higher than fixed deposit, and definitely better than leaving money in a savings account or keeping it in cash at home. Just as an example, uh, and here the point that I'm trying to make is that sometimes, if you have time on your side, especially if you have time on your side, risk may not necessarily be bad, and you should look to take that risk if you have surpluses which you can leave aside or which you can put aside for the long term. Just as an illustration, if you invest 1 lakh over 20 years across different instruments, let's say, if you had invested in the markets by way of a mutual fund, and let's say you invested in a Sensex fund, that would have become from 1 lakh to 10.2 lakhs in 20 years. Similarly, if you had put money aside in a fixed deposit over a 20-year investment period, or over a 20-year period, that money would have translated to about 4.5 lakhs. So in a sense, you can use your the time that you have on your side as an ally or as a tool to embrace risk, right? um, and somebody once said, take calculated risks, and that is very different from being rash, especially because this is concerning your personal finances, right? Now, the second reason, or the rather the third reason why we don't invest, is that we are too busy. uh, we don't have time from our jobs, we don't have time to plan and think about investing. Now, this is, you don't need to be a financial expert, you don't need to study annual returns of companies, you don't need to look at the stock markets on a daily basis. What you need is, effectively, maybe once in a year you need to spend 1 to 2 hours on planning your investments for the year, on planning your finances for the year, and deciding how much you need to put aside every month, how much you need to save every month, and then start investing by way of something known as a SIP, or a systematic investment plan. And we'll talk about that in some time. And of course, now there are various options available that you don't need to visit a bank, or you don't need to visit a broker. You can do it from the comfort of your home. Um, So just to summarize, why should we invest? We should invest for three reasons. One is to beat inflation. Uh, Second is to be able to meet our long-term financial goals. And third is to help us save money or put aside money so that we don't end up spending every last penny that we are getting as salary, right? Uh, Now, let's get into the inflation piece. what do you think has the average rate of inflation in India over the past 10 years? And this is, I'm using 2019 data. Inflation has been averaging between 8 to 9%. And I'm talking about retail inflation, which means that the average cost of goods like clothes, like, groceries, or a car, or, consumables, has gone up by almost 2.5 times over the last 10 years. Uh, think about this in the context of, the previous example that we took, where we were, over the last 20 years, investments in mutual funds could have given us a return of 10x over a 20-year period. Now, what is I kept using the term wants and financial goals earlier on. What is a financial goal? Whether it is a short-term financial goal or a long-term financial goal, it is basically a well-defined expense that we have in the future. It could be a near future, like, maybe when the next iPhone launches, I want to be able to buy it. Or it could be a long-term financial goal, like, for example, I want to put aside money for my retirement, right? So there are two things, and just two things, which define a financial goal. One is, what is the amount that you think you will need, and by when do you think you will need it? By when is probably more important than the amount itself. So which means that, let's say, if you take a simple example, let's say you're 30 years old and you're going to retire when you're 60. So in 30 years time, I will need 2 crores as corpus, or as a fixed amount in my bank account, so that I can live a comfortable life when my salary income stops, right? So this is a financial goal. My retirement financial goal will be, I need 2 crores in 30 years time. And what is a financial plan now? A financial plan is a means to achieve that financial goal. What is the method, or what is the process that you will follow to achieve that financial goal? Now, just to, sort of simplify this, a financial plan can be as simple as saying that I will save 4,000 rupees every month, or 8,000 rupees every month for the next 30 years, so that I can target saving 2 crores at the end of a 30-year period, which is when I will retire. So two things that we, sort of understood or learned from here. A financial goal has a target value or an amount. And the investment horizon, which is a 10-year investment horizon or a 30-year investment horizon, is the time that we have to decide how much risk that we can take. Right? Now, two things. The investment horizon that we have, whether it is, if it's short term, let's say 5 years, 2 years, 3 years, then that is, that means that we cannot take too much risk. We should not take too much risk. But if we have a longer term investment horizon greater than 5 years, let's say 7 years, 10 years, 15 years, then we can take more risk, right? So just to summarize what we have discussed so far, we have discussed financial goals. What is a financial goal? And what we should look to do as individuals, and each one of us owe it to ourselves to do this, is to write down or make a list of these financial goals, the long-term financial goals. Short-term financial goals, all of us will get as we get our paycheck, or as we get the bonus, or as we get a hike. Short-term financial goals will crop up. Those wants will crop up from time to time, but our long-term financial goals are relatively remain constant. I know today that at some point in time, in the future, I will want to buy my own house. At some point in time, I will want to buy my own car, and I know that my hard stop will be my retirement, which is when my salary income will stop. So make a list of your financial goals and try to track how much you are saving to meet each of those financial goals. And this is probably the fundamentally the most important step, where you visualize what you need and you build a plan to achieve it. And I'm not saying that you need to be a financial wizard to do this, and you don't need to put aside too much time to do this. You can start very early, and as you grow professionally, as as your financial situation improves, as your income levels improve, even if you're not able to save enough today, over a period of time, you will start putting aside more money to save for your long-term goal, and as you see yourself reaching closer to your financial goal, and I wish that each one of us is able to reach our financial goals much sooner than we originally planned for. But as we reach closer, it motivates us to save more, and probably give these long-term goals more priority over some of the short-term goals which may be avoidable. Maybe you can wait another 6 months before you upgrade your phone, but you're the decider over there. uh, so what are the pillars of these are the some of the pillars of wealth creation. One, start now, today, don't delay it. Invest as much as you can, and when I say use the word invest, I'm using it alongside of save. So put aside as much as you can for your future needs. If you have time on your side, then you can embrace risk, then you can take more risk. And most importantly, make a list of your financial goals, define your financial goals. Now we come to what are effectively the core of, for each of us as professionals, for each of us as salaried individuals. How do I save this money that I'm talking about? Where do I put this money? Do I put it in a fixed deposit? Do I put it in real estate? Do I buy gold with it? uh, well, each of these are options, and each of these are options which are available to us. We should prioritize on the basis of liquidity, which is how easy it is to take that money out in case we need it because of an emergency, or how easy it is. For example, if I were to invest in a house, it's not very easy to liquidate it, especially if I tell you that in 6 months time you will need money, and for that you need to sell this house which you purchased as an investment. So it's not going to be a very easy task to be able to sell a piece of real estate, especially when you need it, right? So that is liquidity. The other is the duration of investment, which we already discussed, that your investment horizon decides how much risk you can take, how much risk you should take, and the kind of instruments that are in which you should invest. This is where mutual funds come in. So a very quick summary, and I'm sure you're all smart enough to know this, but let me give you a quick summary of what effectively is a mutual fund. And I'm using layman's language, not technical language, not regulatory language. So to explain the concept, so investors such as ourselves, when we put aside money effectively into a mutual fund, effectively what we are doing is we are pooling our money. We don't know each other as investors. I may be investing in certain mutual funds and you may be investing in certain others, but effectively, a number of investors pool their money and give it to a mutual fund which is managed by a fund manager. Who is a fund manager? A fund manager is an expert in financial markets whose job it is to manage this money and to invest it in various instruments. Those instruments could be stock, by investing in the stock markets. Those investments could be in deposits or bonds of companies. So you're basically entrusting your money with a fund manager whose full-time job it is to manage the risks associated with investing and to generate returns from that. These securities, these investments that the fund manager does through that mutual fund scheme is what then generates those returns for you. So if the mutual fund manager has invested in stocks, then an increase in stock prices over a period of time will generate a capital gain for the mutual fund, or a gain or a return for you. And when you sell your mutual fund investment, let's say 5 years or 10 years down the line, you will be able to realize something known as a capital gain. This is one, this is a very simplistic explanation, but you get the point that mutual funds, effectively you're giving your money to a third person who is specialized in investing, whose full-time job it is to do just this and generate return for you. And these returns then come back to you, which you can then use to meet your financial goals. So effectively, in a very short one line, you're basically letting your money work for you, and that is a core of investing, and that is mutual funds are a great way to do that. So why should we look at mutual funds? One, because they are professionally managed, which means that there is a fund manager whose full-time job it is to do this. They are able to diversify risk, not put all your eggs in one basket, which we are likely to do, especially when we are taking a decision. We can't buy multiple houses, one in a particular location, another in another location, to diversify our risk. A fund manager is able to do that because the pool of money is allows them to identify different stocks, different across different instruments, and allocate money in a manner that such that your risk is diversified. Uh, all mutual funds are regulated by SEBI. There is a who's a regulator, and they have to be regulated, and mutual funds have to be regulated and registered with SEBI, and they're safe and transparent. Now, how do you choose? And there are now, if you go down this route of investing in mutual funds, you will be presented with a vast variety of options. And how do you choose which is the right mutual fund for you? Again, going back to the previous point that we spoke about, what is our investment horizon is what determines how much risk that we should take. And of course, a little bit about what is our attitude towards the risk. If you have invested money and you are going to track it every day, that means that you have slightly lower risk appetite, and you should invest in less risky mutual funds. And I will just, in the interest of time, I will just summarize this for you. um, Mutual funds risk, the hierarchy is from liquid mutual funds, which is the lowest risk category of mutual funds, to sectoral equity funds, which is probably the highest risk uh, category of mutual funds. So these, if you are investing for the really long term, you should think about taking more risk. If you are investing for the short term, then you should take low risk, and therefore liquid mutual funds when you're investing for short term, equity funds if you are investing for the long term, and your portfolio can be a mix of both. So that concept is asset allocation, where you invest partly into debt mutual funds, like liquid mutual funds is a debt mutual fund, and the remaining into equity mutual funds. If your investment horizon is long, then you can invest majority of your funds or majority of your savings in equity mutual funds, and the remaining in debt mutual funds. Now, what are things that affect mutual fund returns? Of course, they are mutual fund investments, and you will all have heard this. Mutual fund investments are subject to market risk, and you should understand what the mutual fund scheme that you're investing in, what is the objective of that scheme. But broadly, you should think about it in this way, that larger the equity piece, larger the investments that the fund or the scheme is going to do in equity markets, the larger the risk that is involved. The shorter, the lower the risk, the lower the investment horizon, and if you invest in debt mutual funds, the lower the risk you can take. Now, another common question that we get is, how many mutual funds are enough? So you should think about not more than 4 to 5 mutual fund schemes across different categories, so that your risk is diversified. You should definitely think about large cap funds. You should think about debt funds, but not more than 4 or 5 categories across which you should choose. Pick one fund each, right? There is little advantage in buying multiple funds from the same category. And we have seen this multiple times, where people who have been investors who have been investing over 10 years, 15 years, because they'll invest on the basis of, not on the basis of their financial plan, but on the basis of their investment, but on the basis of their investment broker or what they are seeing in the market. They will end up with a large number of funds in their portfolio, which is not required. So most importantly, it becomes harder to manage the larger the number of mutual funds that you have in your portfolio, right? Now, how should I invest this money? The simple rule is, when you have a surplus, put aside that money. If you are salaried, you are getting monthly income, you're spending some money on your monthly expenses, you may have some short term wants which you want to fulfill, you may have tax deductions that you want to meet. After that, whatever is left over, you can put that money aside into mutual funds. A very useful tool, especially for salaried people, is a systematic investment plan where you put aside the same sum of money in the same mutual fund for a long period of time. It's like a fill it, shut it, forget it concept, where you keep investing the same sum of money for a long period of time without having to do anything every month, because it happens automatically. So this is a systematic investment plan. You can save small sums of money. It is lighter on your wallet, and it is very light on your time, because you only have to set it up once. It also helps you to avoid trying to time the markets, which is also an important concept, but that is a discussion for another day. And it helps you catch markets when they are high, when they are low, without having to yourself monitor markets on a daily basis. Uh, what do you do when this is for, this is obviously when you have regular salary income, but you may also have an annual bonus, or you may get a windfall gain because you've inherited some wealth, or you have sold property which has got you some surplus money in the short term. That money you can look at investing by way of a lump sum investment. So the simple concept: invest when you have surpluses are available. If you have monthly salary surpluses, those should be invested by way of an SIP. And if you have windfall, which is like a bonus or property gains, then you can invest that by way of a lump sum, right? Uh, Now, just the just you've understood what mutual funds are and how you can start investing in mutual funds. uh, just a simple concept that you need to understand is, the fund manager is doing this job for a fee, and this is known as the expense ratio of a mutual fund. So when you do start investing in mutual fund, do think about whether you want to invest, and the type of funds, what are the expenses involved in investing in these funds. And in general, a good fund and a low cost are not necessarily related, but in some of us associate higher cost with higher quality. That also may not be true. So do look at the expense ratio of funds while making that investment decision. Also look at some of the fine print, which means, if you're investing in, for example, if you're investing in tax saving into ELSS funds, then your money will get locked in for 3 years. So do you want your money to be locked in for 3 years? That is a decision that you may want to think about. So that is broadly how investments funds work. This is the concept of we spoke about the concept of investing. We spoke about having financial goals and planning for your how to plan for your financial goals, and having a financial plan in place. I hope you found this useful, and I'm not sure if there are time for questions, but I think that's what I had to say.
I would like to ask you, Neelabh, one question.
Yes.
So, Neelabh, as the market is going higher on this side, like Sensex has touched 50K and it's just bounced back to 49K. So, what do you think? Is mutual fund a right decision to invest at this particular time? To start with an SIP into equity mutual funds?
Let me put it this way: if you have a long-term investment horizon, and if you don't need, if you don't need the money immediately, then you should stay invested, irrespective of where the markets are, right? If And we keep getting this question from investors that the markets are at an all-time high, because the markets hit all-time highs very frequently, right?
Exactly.
Today's all-time high, probably would seem unachievable if you had asked me the same question in February 2017, because that's when the market hit the previous, another all-time high, right?
Yes.
So, frankly, I don't have an answer to that question as to where the markets will go, and I don't think anybody does. And I will pay a lot of money to understand if somebody can predict markets accurately. So we cannot predict markets accurately. The principle is that if you don't need the money, let it work for you. Stay invested. uh, your returns will be linked to markets. Your returns will be linked to how financial markets are doing, how the economy is doing. And in the long term, we all hope that India continues to do well. India continues to be powered by people such as yourselves, and hopefully a lot of people who are attending this session. So we will continue to do well. Markets therefore should continue to do well. And 50,000 is just a number.